Hey guys, happy Monday. Doing another video update on the market, trying to educate the public and bring everyone's level higher so we can make smarter investment decisions in not only the market but in all our financial and economic decisions. I am going to cover the broad market, general broad market, the 500 largest stocks, and the major indexes, the broad market, because what I'm looking at is a potential risky position in prices. What that means is I'm concerned because this is a very good spot to lose money. This is a very good spot where the market can fall. And if you own stocks or you're worried about negative downside in the market for whatever reason, this is a good spot to be alert and beware. Very often in this situation, the market does fall. Does that mean I know the future? No. Does that mean I can predict this? Not necessarily. It just means that when the market has fallen before, it's done this. And what I'm talking about is, if you look at the S&P 500, which I have up here for you, and you look at the moving averages and the price action, every time it falls, it starts like a tree, like falling from a tree. You hit these branches. So every major decline, there was a really high price, and then it started taking out support levels, and those support levels are the moving averages. And if you look in here, I have a 10-day moving average, which is the red line. And for the past year, not every time, but about, I think it was like 61% of the time in the past 5 years, once it broke from the 10-day moving average, we at least went to the 50-day moving average. So breaking from that first red 10-day moving average was a bad thing. Not always, but it was a sign for concern. In the past, the COVID sell-off was a very, very good example of the worst case scenario, which is a massive sell-off. And that's going to be in memory for a few years, because that's how it seems to happen. These sell-offs happen frequently, but we forget, and then the market rallies up again. And we're at that spot again. We're making new highs on most of the indexes, not all the indexes. The Nasdaq didn't get all the way up. Maybe it goes up, maybe we don't know. The Russell did the best in this period. But if you look at the S&P 500, which is our best measure of the market because it's broad and big, we're testing that level again right now. And I do believe we break through it, but I can't tell people what's going to happen in the future because I don't know. All I can say is that I'm observing it, and the RSI is weakening. It's going sideways because it goes up, it goes sideways, and it goes down. That's all I can do. Those are the three directions: up, sideways, down. And I think unless it turns around, it's getting worse. And we're also going to look at the volatility, the dollar index, and then the greed index. Let me look at the greed index now, just to change it up for you. If you look at CNN Business, they have this greed index, and it's just a measure of indicators that anybody can look at, but the way they do it is very nice and pretty, the way they organize it. And according to their fear and greed index, it was 92 on Friday, but it hit 88. It hit 88 right now. So, like Warren Buffett, who's a famous investor, he always says you want to buy when there's blood in the streets. You want to buy when there's maximum fear. You want to sell. I think a saying is be greedy when others are fearful, and be fearful when others are greedy. This index just shows that. So maximum green means everyone agrees the market is good. Everyone is bullish. Stocks are up. everything is rosy. Maximum fear shows that, hey, everyone's worried, a lot of people already sold stocks, the market is down, people aren't confident. So in order to get the best price, you want to buy when nobody wants, but there is risk in that. In order to get out at the best price, you want to get out when the prices are high and everyone's happy. You may miss out on opportunity, but generally, if you buy when everything is low and scary, and you sell when everything is good and rosy, you're gonna get the prices. You're gonna get the profit in between that. If you look at the bottom, they have the fear and greed over time, and the beginning of the sell-off this year, the fear and greed index, the greed level was high, and then we sold off, and that was a great time to buy. And right now is a great time to sell, and guess what? The fear and greed index is high. So that's the very easy guide to know when you should be shopping and when you should be exiting. Right now is a potential exit period. Now I can't tell you to just sell outright because, again, we're pretending we're driving in a fog and we don't know what's on the other side. We're only looking at the clues to try to make good decisions. But this looks like a high period, and we will probably see, or we could see, a sell-off. Does that mean you should sell everything? I don't know. What I do recommend is stop losses, or at least some kind of a plan. If you have ETFs or stocks, you can put stop losses. You have to speak to your tax advisor to make sure that's practical, but if you sold, there might be tax consequences. And I can't advise you on that or on anything. But stop losses are a great strategy to avoid major sell-offs. And if you get kicked out because it sells, you can always put a stop loss to get back in. You could sell positions and then put a stop loss above the current market. Like if you sold your stocks now, you can put a buy stop above and then avoid any potential sell-off and then get back in over time if the price starts to run away up. But I do recommend people having a plan to reduce risk, which could be using stop losses. And you can put stop losses real low, you can put them real close. It just depends on how conservative you want to be. I think everybody would agree that a large sell-off is what people want to avoid. What is that, like 10%? So maybe stop losses at least 10% below where the market is would be a good idea. I would be more conservative than that. Like at the moving average or even above the moving average would be good, because this behavior is a coiling up process. This is a coiling up process. If you look at the Dow, it's coiling up. I have these like swing signals that I saw from another YouTuber. He had these little signals, these little notes that would go on. I like them. They right here in the Dow, the fact that they're triggering up and down, up and down, up and down, that's a choppiness. That's a coiling up warning. What that usually means is people are getting trapped. There's bulls in there, there's bears in there, and they're getting trapped. There's going to be an explosive move, either up or down. I did that backwards, but you know what I mean. Either we'll get a big sell-off or a big shoot up, like in the Russell. The Russell had one recently. It's been coiled up, and it really shot up. This is the best month ever in the history of the NASDAQ, as far as I can tell, and I think it was in the news. This is, if I look at the monthly chart, that's a big monthly bar in the Russell. You can go to the weekly. We had like this island of prices, and it's gonna test lower levels. I really believe after this, that was the election spike, and then crude oil shot it up higher, and we tagged that moving average that I'm telling you about. If we close below it, it will definitely be a bad sign for the market. Every time we've closed below in recent periods it was bad. There was a period in July that we were able to push through it, but for the past, what is that, 3 months, 2-3 months, it's been a very bad sign, and I'm concerned that the next time it may not recover, and it could be a good old sell-off. And if you look at the VIX hasn't had a good spike to the upside, and it's very discounted, at least for this year. And I would be concerned that a tag above the VIX measures fear level and the put prices, the insurance protection prices, which are put options. Right now, there hasn't been a lot of relative buying, and if this RSI starts to swing higher, that could be the signal that something's coming on the way. The dollar index has been concerning. Let me see if I can get it up here. All right, here's the dollar index, and the dollar index is at a dangerous level. Actually, we're below that dangerous level. So right now, the dollar is in a spot where it can just continue to sell off, or it can do a violent spike higher. I have no idea what it's going to do. If I had to speculate, I would bet on a spike, but I would want to see confirmation. Right now, this is bearish for the dollar. The dollar is not looking good, but it's correlated and has been correlated with downside. So if the dollar starts to rise, if we start to see green bars, that would be bad for risk assets, for the market in general. This doji or green candle, this is like an indecision candle. If we see that with maybe bonds rising, if the bonds start to rise and the VIX starts to rise, well, it's like going outside when it's already raining. Then we know bad news is already here. That would also be in sync with red bars in the market. So by that point, the market will be confirmed. The market will already be declining, and your risk plan should have already been in place. If you're long stocks, doesn't matter what stocks you're in, like even Tesla, which is one of the best performing stocks ever, you gotta have some place where you reduce your risk, and then if you get knocked out, you can always get back in, even if you miss some of the upside. They don't move up 100% in one day, not these big companies. And a lot of these companies are already huge now. So if you look at something like Tesla, it's got negative divergences. It's in an uptrend, but it wouldn't be a bad idea to have a stop loss, at least somewhere around 520. Okay. I don't think everyone is sophisticated enough or advanced enough to do or should do option trading, but if you look at the S&P, if you're more an advanced person or a speculator, someone who has more investing experience, like I would be looking at put options on the market as a speculative trade. Just a small trade would be enough. But I've been looking at the 400 put, something like June of next year. That's about $5,000, $4,600. I don't know if there's any trading on it that we can look at, but the put options are complicated, and I probably shouldn't even cover them because most people won't be that interested. But they would be interesting as here's a put. Maybe I'll get a chart. Okay, I won't be able to get a chart on this, but put option will make money if the market goes down. It's $5,000, and you control the S&P at 400, which is what is that, 40,000. So it's a put option and it makes money when the market goes down. This one, in the money, the way it's designed, you'll avoid some of the time decay and you'll get a big old pop benefit if the market goes down. If you look at the S&P right now, see, you'd be buying the 400 level and you'll get almost point for point if whatever the market sells off in that option real quick. If it went from 360 to, let's say, 26, what is that, 24 points, you'd get most of 24 points, which is $2,400. You would almost get a 50% return on your money if the market declined like that on a 10% move. So that's a put option. I don't think it's for everyone. I can't guarantee it's going to work, but even now, this is a live chart. We're looking at the market, the hourly bars. That's a red bar, so it's gonna get interesting. I know the Russell was doing poorly. The Russell's got non-stop red hourly bars. NASDAQ is doing the best with this. It looks like a bear flag, but if the market as a whole starts to sell off, it's going to have a chain reaction of negative reactions, just negative moves. See the VTI, which is a broad, like the total market index, that tagged the moving average, and there's been multiple tags before, but if it breaks below, I would expect a quick move to lower this lower cluster of prices. Same thing with the Dow, S&P. Russell, I would say, is the most dangerous because it's run up so much. That's going to be the whole video. Let me see if I can get. Here we go. This is the percentage of stocks above the 200-day moving average, and the RSI indicator is already starting to roll over, and this is what I'm concerned of. If this is a percentage of stocks above the 200-day moving average, and it tells us if the broad market is bullish or bearish. And here you can see the pandemic sell-off. That got as low as like 5, and right now it's at 82. So if it cools off, you're going to see a lot of smaller stocks and bigger stocks start to get closer to the 200-day moving average, and then maybe test it. I don't know how much, but if you just look at the trend, we've got a 50-day moving average closer to 60. Maybe it goes closer to 60. That would be quite a few percents, maybe 5 to 10%, maybe more, of a sell-off in the market. So this video is for education purposes. If you have any questions, go ahead and comment. Enjoy the video, and I hope it helped. Cheers.